Will Chinese real estate company Evergrande crash the stock market? You decide. Let's go through it. This is Andrew Stotz of A Stotz Investment Research. Let's get started. So, in this video, I'm going to look at the real estate sector within the Chinese stock market and have you think about whether Chinese real estate company Evergrande is going to crash the stock market. Next, we'll look at what makes real estate companies so different. If we understand this, it will also help us. So let's look into this in more detail. Let's understand the Chinese stock market. In order to do that, I took 1,549 companies. They're the largest companies out of about 3,400 companies, and I aggregated them up in a bottom-up analysis. I looked at A shares, B shares, and H shares. They're all Chinese companies. It's just a matter of where they're trading. And let's just look at the overall Chinese stock market using this information. The first thing we want to look at is the market capitalization. And here we can see the Chinese stock market capitalization is $12.2 trillion. And the largest sector is the financial sector, which is $2.7 trillion, or 22% of the market. Infotech and industrials each are $1.5 trillion, or 12% of the market. And real estate is now the smallest sector of this universe of 1,500 companies at about $200 billion, or 2% of the market. So will Evergrande crash the market? Well, maybe, but that's a pretty small size for property companies relative to the overall stock market. Of course, property companies have an impact on financial companies because financial companies do the financing of projects. Let's continue. Let's look at the number of companies. Again, I looked at 1,549 companies, and I added them all up and looked at their balance sheet and income statements. Now, most companies are industrial, infotech, and materials. Only 46 in this particular group, in this data set, are real estate companies. Here we can see the return on equity of the companies. Well, what do we see? First of all, China has a return on equity of about 13% versus the world at 15%. The worst was energy and utilities, and real estate was, not bad, 14.6% as of the time. Now, this is analysts' forecast to 2021, so pretty bright forecasts. Let's look at the PE ratio to see if the market's expensive. What we can see from this is that the PE ratio of China was 14.8 versus the world at 18.9. So technically, you could say China is cheap. Consumer staples, communication services, healthcare, and infotech all are trading over 30 times PE, so they're very expensive. But real estate, financials, and energy are all trading below 8 times. So at such low PEs, how much more damage is the real estate sector going to do to the Chinese stock market? That's for you to think about. Now, if we exclude the financial companies, which are about 22% of the overall market, the PE of the market is actually closer to 20 times. So it is not necessarily a cheap market, but a heavy weighting in financials, which are really cheap, is causing it to appear a little bit more cheap than it may be. Now let's look at earnings growth, earnings per share. What we can see is that 2021 EPS growth is forecasted at about 30%, and world is forecast at 49%. It's a huge recovery this year. Consumer staples, real estate, and utilities had the lowest growth. You can see real estate at about 7% growth forecast as of the time that I'm talking about this. This is October 15th. So energy, materials, and industrials earnings are rebounding. And finally, if we exclude banks, and that 29.8% becomes 48.3%. So banks are dragging down some of the earnings there. Next, let's look at the change in share price. Well, first of all, in this universe of 1,500 stocks, this is not the stock market, this is the universe, so it's not like an index, but it's my own index that I'm calculating. China was up 10.3% year on year, and the world over that time was up 24.7%. real estate, communications, services, and financials prices fell. You can see real estate's down 19.9 or 20% in the past 12 months. And energy, materials, and industrials, utilities prices rebounded. So last, let's look at leverage, the amount of debt. First thing you'll see is Chinese market gearing is in line with the world, and massive gearing in real estate and utilities. Now, real estate companies tend to be pretty highly geared, but I would say that's very highly geared. So will the Chinese company Evergrande knock down the stock market? What do you think? There's almost no leverage at the consumer staples and very low at communication services, healthcare, and infotech. So what have you learned in this section to try to think whether Evergrande is going to crash the Chinese market? Financials were 22% of the Chinese market. Infotech and industrials were each 12%. Real estate is now the smallest sector at 2% of the market. But remember, the market is about 3,400 companies, and I'm looking at a sample of about 1,500. So it could be a little bit different, but not that much different. Most companies in this data set are industrial companies, infotech, and materials. Only 46% in the first data set were real estate. And return on equity of China was 13% versus the world at 15%, and real estate was about 15%. Doesn't seem too bad. And that's the analyst's forecast for 2021, the year we're in. China's PE is 15 times, but closer to 20 times if you exclude financials, and the world's trading at 19. Seems kind of cheap. Consumer staples, communication services, healthcare, and infotechs all are trading above 30 times. Seems expensive. Real estate, financials, and energy are all trading below 8 times. Seems cheap. 2001 China EPS is at 30%. If you exclude banks, it would be at 48. The world is at 49. And the last part, China's share price in this universe was up about 10% year on year, while the world was up about 25 for that time period in this group. Real estate, communications, services, and financial prices fell. Energy, materials, industrials, and utilities saw their prices rebound. And China gearing is in line with the world, but it's massive gearing in real estate and utilities. Okay, so my question to you, is Evergrande going to crash the property market? I would say property market's pretty small within the overall market, but it does have ramifications to the banking sector, and it has ramifications to the overall market. Let's go into the next section, which what makes real estate companies so different. We need to understand them to better analyze them. So first, let's look at gross profit margins or global profit margins. I've collected 13,973 companies into one data set here, and then I made a common size P&L of 3 years of data for these companies. And what I found was gross profit margin was about 28%, EBIT margin was about 9%, and net margin was about 5.2%. Now, let's look at global real estate companies because they're very different structure. And here you can see gross margin of 28.9%, EBIT margin double what typical companies have as an EBIT margin. So our real estate is 20.8%, and net profit margin also double the net profit margin. This is the structure of real estate companies relative to all other types of companies. So now we have a good comparison in the real estate sector. Let's look at Chinese or China real estate, and here it is. We can see a lower gross margin at 23.5%. That's a little worrying. And what we can see, though, is that they make it up. SG&A is lower in China. And as a result, well, same EBIT, about 20%. And net profit margin is a little bit lower at 9%. But I would say for the 100, now, in the first chapter of this video, I talked about 48 Chinese companies in that universe. This universe is different. It's 112 property companies in this universe. All right, let's look at the balance sheet. We're going to see that mainly net fixed assets is what business is all about. We're going to look at, this is the global companies, and inventories are about 11% of total assets, whereas what we can see here is net fixed assets are about 30.7 as a percent of total assets. So what about real estate? Well, here we can see Inventory is 41.3% of total assets. That's massive. And net fixed assets are only 9%. Why is that? Because real estate companies don't have factories and lots of physical assets. The only time they really have physical assets is when they buy a piece of land and then they build something on it. As they build that product that they're selling, it's an inventory item. So real estate companies always have a lot of inventory. So let's look at Chinese real estate, and what do we find? 52% of assets in Chinese real estate companies are inventories, and 2.9% are net fixed assets. Here we can see Chinese companies are holding a lot of inventory. All right, let's look at liabilities, and this is where these companies also are very unique. We have inventory on the one side. Let's look at liabilities. But before that, let's just look at 13,973 companies across the world, and the other current liabilities is about 12.6. It's like taxes payable, dividends payable, payroll, things like that. And then let's look at total equity. It's about 38%, let's say. Okay, what about real estate? Here's where you start to see a very big difference on the liability side of the balance sheet, and it's 28.5% of other current liabilities. Why is that? That's double the 12.6 of all other companies. It's because real estate companies take down payments from customers, and then they use those down payments combined with funding from banks, and they take that and then they start a project. And as the project comes, they're financing it from their customers. And if we look at the Chinese companies, we can see 36.7% of total assets are financed by this customer deposits. We can also see that total equity is a lot lower. So for every 100 in assets, there's 20 basically in equity. That means it's about 5 times geared in that measure. So what can we learn from this? Well, one of the interesting things, and one of the questions about will the Chinese company Evergrande crash the Chinese market or the Chinese economy? What's interesting about this is that if we look at I'm just going to grab my little pen here and point out something, and that is if we look at, let's just look at long-term debt at 19.6, that's not much different from 21.9, but that's probably 20 or 30 or 50 banks and some other investors that they're borrowing from. But this 36.7% is borrowed basically from the down payments of millions of customers. So to think about whether Evergrande is going to crash the market or crash the economy, you have to ask the question, is the Chinese central government going to allow millions of people to lose their deposits? What do you think? That's how we have to try to interpret it, because I was just talking with a good friend of mine, and he went through all of these very negative outcomes, which seem very plausible. But remember, the difference between a real estate company and a typical company is a real estate company may have thousands and thousands of individuals who are lending them money. All right, let's look at another way of looking at inventory is look at inventory conversion days. And that means basically it takes 80 days to convert inventory from raw material to sale. And that's for companies across the world. But what about real estate companies? Oh my goodness, it's 10 times more days that they have of inventory on the balance sheet. This is normal. 844 days for real estate is normal for real estate globally. Why? Because the price of their inventory is very high. And what they're doing is they're holding that inventory for 1, 2, 3, 4, 5 years as they construct the project. So it's very natural to have a very high inventory conversion period, and this also impacts the way we value these companies. So what about Chinese real estate companies? Well, here we can see 1051. It's higher than the global average, but is it unreasonably high? I would say no. So yes, it is high, but we know that property companies do have a lot of inventory. And so the question is that going to crash the Chinese stock market or the Chinese economy? It's possible. That's a lot of inventory that they've got to clear out. And if people stop buying, then all of a sudden there's no buyers. All right, let's look at ROE. If we look at the global company, we can look at the return on assets of 3.5. We multiply that times the assets to equity ratio, which is just a measure of leverage, and we get to 9.9. So what we can see is that it's kind of split 50-50, 3.5, 2.9, roughly about 3 and 3. 3 times 3 is 9. That gives us the ROE. So what about property companies worldwide? Well, here we can see that their return on assets is much lower. Property companies have a much lower return on assets, but look at that net profit margin. It's double the other companies, right? So they have a lower return on assets because they also have a very low turnover rate because they're holding their inventory for a long time. Then they have more leverage. You can see the assets to equity is 4.5. That gives a return on equity of 11.4. What about the Chinese companies? Here's what you can see. Profit margin is pretty good, but that return on assets is now down to 2.1, and the leverage is at 6.9. Remember, they have a small amount of equity and a lot of debt and also a lot of assets. And the result of that is that we're getting this, what I called respectable ROE of 14.8, but you could say that that is at risk because margins could fall, returns could fall, and leverage could rise. Okay, let's summarize what you learned, and then I want to hear your conclusion. China real estate profit margins were slightly lower than the global real estate market. China real estate balance sheet assets had higher inventory and lower net fixed assets than global. China real estate balance sheet liabilities had more customer funding and even less equity. China real estate company inventory days were 1051 versus the global real estate at 844 days. China real estate ROE of 15% was driven by 6.9 in leverage. That's much higher than the global real estate ROE of 11% and leverage of 4.5. So let's end this video by asking the same question that we asked at the beginning. Will Chinese real estate company Evergrande crash the stock market? What do you think? I say it's already had its impact. The market, that sector is down 19.7%. It's already been hit very hard. I don't think it's going to have much more effect on the stock market, but it could have, and it could also have a massive effect on the overall market. What do you think? Put your opinion in the comments below. I'll see you in the discussion.